Ignore the news and keep your eyes on the actual prices of goods and services in the global economy. They are what people are buying and selling for, and they tell the truest information. And from what we can tell, gold and silver are rising, which means the dollar is dying because everything really is priced in gold. Nothing really is priced in the dollar since the dollar is a gold derivative.
Gold is about 6 to 7 months behind the 1972 breakout. Now that breakout peaked at 9,200 in early 2027. So where did the 75.25 breakout peak? 8,000. And so look at this. We'll layer on 6 or 7 months. So this is about 11, 12 months from now. So what this chart could tell you is there's potential for 8,000 target. We'll just call it late 2027, maybe 18 months from now, maybe 20 months from now.
Gold and silver clearly indicate the condition of the global monetary system. As their prices rise, this shows the decline in fiat currency purchasing power, not just reactions to news or short-term events. Rafi Farber, a macro analyst, and Jordan Roy-Byrne, a technical strategist, say price action is the most reliable economic indicator. Comparing now to the 1970s, gold seems to follow a similar path with a delay. This suggests gold could reach $8,000 by late 2027, driven by ongoing currency debasement and strong demand. Focus on actual price trends, not news, as markets reveal true value over time. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This is my gold major breakout analog chart. So we have the 3 major breakouts in gold's history here. The current one is, of course, in black. But I'm not showing the 05 breakout, but I am showing the 1972 here in light blue. And also, this is the average, this other line. It's the average of the two. But I've tweaked the average because before the average was 50-50. Now the average is 75% the 72 breakout and 25% the 2005 breakout, because I think that fits better. This breakout is way closer to the 72, although it's not quite as strong, than it is the 2005 breakout. So I opted for 75-25 for that average. And another thing I want to note is that this breakout compared to the 72 breakout and that 75-25 average, it's about 6 to 7 months behind. Here's what I mean. Look at this peak in gold here and now, where I have this B, where it corrected 27% already. This was the peak in 72, where it corrected 28%, okay? Look at the peak of the 75-25 average. It basically peaked right where the current market did. And if you go back to the beginning, we could clearly see, there were 2 big legs. After this pause here, there were 2 big legs in that 72 move. And with respect to where was that pause in the current breakout move, well, it was right here. And then we had 2 big legs here. It's not perfectly identical, but when we look at where the A's are, where this recent peak was, gold is about 6 to 7 months behind the 1972 breakout. Now that breakout peaked at 9,200 in early 2027. So where did the 75-25 breakout peak? 8,000. And so look at this. We'll layer on 6 or 7 months. So this is about 11, 12 months from now. So what this chart could tell you is there's potential for 8,000 target. We'll just call it late 2027, maybe 18 months from now, maybe 20 months from now. And it's important to understand that, and I've showed this in past videos, a lot more capital is going to come into gold and precious metals. That's going to push gold, silver, gold stocks much, much higher. But you can see it here on the charts. The gold breakout against the stock market. Okay, you're probably getting sick of me telling you this. But what this indicates here, and the fact that it's held the breakout, this indicates that a lot more capital is going to rotate out of stocks in the stock market and into gold. Okay, it doesn't mean it's going to happen tomorrow, next month, or next quarter, but 3, 4, 5, 6 months, you're going to see the capital move in, and this is going to move like that, okay? Where's the capital coming from if we're digging down? It's coming from tech. It's come out of a lot of other sectors. It's coming from tech. This is gold against the NASDAQ here. Look at this. A beautiful pattern going back to 2017. This is a 9-year-long base here. Here's the NASDAQ 100, which is way more techy than the NASDAQ itself. This also has a 9-year-long base. Look at how beautiful this is. I mean, look at the symmetry here, the polarity. Support, resistance, resistance, resistance. Again, it's going to take some time, but where is this thing going? It's going to move like that, okay? And so we're going to see a lot more capital moving out of tech and into gold and precious metals. Gold against the Mag 7, the chart doesn't go back far enough, but I'm looking right here. We can see there was a peak right here a little bit before when the Mag 7 ETF was introduced. And so this is probably the resistance right here, and that's why you see a pullback in gold against the Mag 7, okay? So this is another ratio that's going to eventually move like that. So again, capital is going to move out of the stock market and tech stocks and go into gold and precious metals. Okay, it's very important to understand there is huge room for more capital rotation coming. Now, moving on, let's talk about gold stocks against gold, because this is one of the most important ratio charts to focus on right now. Here's GDX against gold. Here's the XAU against gold. Okay, look, 13-year-long base. Okay, what does this mean? Well, if you get a move like that, that means capital is moving out of gold itself and into the gold stocks. Again, XIU against gold, look. And people, I'm not saying this is going to break out in the next month or the next 2 or 3 months, but the key is this is a really big time setup here for the next 6 to 12, 18 months. And it tells you what could happen, that there's potential for capital to accelerate out of gold and go into gold stocks. Looking at the gold stock technicals in the short term, here we have GDX, GDXJ, SILJ, and this rebound has gone above some key resistance points. So with respect to GDX, now we would look here at this level right here, which, call it around 105. Market's at about 99, 100 right now. Same thing for GDXJ. So you could get a little more of a bump here, maybe to 140, 135-ish. SILJ, the next resistance would be right here, 35. So I'm not taking profits on anything or trying to hedge or do anything like that. Remember, people, the big money is made buying quality companies at good values and holding. And that's what we're doing in the Daily Gold Premium. 2 or 3 weeks ago, we had buy signals on most to all of our stocks. Now, maybe the sector can push up a little bit more, but we'll have to wait and see. Either way, in either scenario, the bullish or the neutral scenario, you're going to get some kind of a chop and pullback here.
Gold's breakout matches historic bull market moves, especially those of the early 1970s. This pattern suggests the market is in a mid-phase, not at its peak. Comparing this cycle to past ones, the current structure lags by months, hinting that the strongest phase is ahead. History shows multiple advances after pauses, and now's price action appears similar. Capital is starting to shift from tech stocks to precious metals. This trend can accelerate as momentum builds. The setup suggests gold, silver, and mining stocks could revalue higher as investment flows change. Let's get back to the interview.
I'm not going to talk about silver at all. Why not? Because I don't want to, and the more interesting stuff is happening anyway in the gold market. The gold futures market has not gotten control back of the gold price. Open interest remains extremely depressed, has not recovered despite the supposed ceasefire between Israel and the US and Iran and Hezbollah and whoever else is throwing bombs at each other. And this ceasefire has not really accomplished much, but conditions in Israel, actually, where I am, are a little bit better. There are fewer sirens, though I didn't have that many sirens in the first place. I haven't had any in the last 72 hours. First of all, we see here the interplay between open interest and the gold price. Talked about this last week, but there are some other interesting details here that I didn't point out before. The blue is the price, and the green bars are the open interest. You can see here we are below 360,000 contracts still. We went up slightly. It looked 2 days ago that we were up about 20,000, 375,000 contracts, but those turned out to be preliminary numbers by the COMEX or the CME or whoever runs that thing. And it turns out that preliminary numbers can be way off the actual numbers. Why? I don't know why. I don't know what the mechanics are here, but that's what it is. So we're still at very, very low open interest numbers that we haven't seen since 2012 or 2008. Actually, 2009. That's the one. Post-financial crisis. This is extremely low, which means that liquidity in the gold market is going to be very, very low, which is exactly what we are seeing. But I want to point out these candles over here. You see here that open interest maxed out at about 540,000 contracts over here, just before gold topped at $5,600 an ounce. And in this candle where you see the top at $5,600, the open interest in gold had already started to fall drastically back down to, on that day, 460,000. So about 80,000 contracts were liquidated as gold was topping. And then one day later, gold crashed to, what is that, $4,700, and then back down to $4,400. So we went from about $5,500 to $4,400, an $1,100 move. What is that, about 20%? No, it's less. It's like 15%. It's still a lot for 2 days in the gold price. And open interest had already fallen by a lot by then, which means that whoever was doing that may have had a clue that gold was topping. And I'm not going to point to any conspiracies here. Some people who can track liquidity flows either by AI or algorithm or whatever, and they can see certain movements being made, which I don't have the ability to do because I don't have the data or the expertise to figure those things out. Some computer programs can figure it out, and some had, I guess, programmed that or figured out that gold was going to fall in those times because of those numbers. And some firms actually do this and they're wrong a lot, and some firms do it and sometimes they're right. It doesn't mean that they know anything insider or illegal or they're manipulating anything beyond what the system already manipulates. But this is what we are seeing here. We're seeing the open interest numbers fall right before gold topped. But now we see here that open interest is still below 360,000 contracts, even though the price has climbed from about $4,100 to now $4,800. So we moved about $700 with open interest falling even further. There are very, very few speculators in this market, and as the numbers continue to fall or as they stay around these levels, the liquidity in this market is going to be very, very scarce relatively for gold, which means the gold price will remain volatile. That includes silver because silver follows gold in volatility, normally speaking.
Gold is moving higher amid unusually low participation, creating a unique market setup. Prices have recovered strongly, yet the underlying futures activity has not followed, pointing to a shift in market structure. The key signal comes from the persistent decline in open interest, which remains near levels last seen during major stress periods. Typically, rising prices are supported by increased participation, but the current move is occurring with fewer speculative positions. This suggests the rally is driven more by underlying demand than by leverage trading activity. At the same time, reduced liquidity increases the potential for sharper price swings, as smaller flows can have a larger impact on price direction. Historical patterns show that when prices rise while participation declines, volatility tends to expand rather than contract. This creates conditions for continued upward movement, but with sudden and aggressive corrections along the way. The broader structure indicates that the trend remains intact, even as short-term movements become more unpredictable. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.